Well, hello everyone. My name is Roger Scott. I'm the head trader for Wealth Press. Today is June 1st. Where has this year gone? Honestly, I ask you. I remember celebrating the holidays. It was just like yesterday. The year's almost halfway over. All right, well, it's Monday, and as I always say, let's get into it right now. And today I want to tell you what we should be expecting for the week ahead. Let's start out with global data. There's been a lot of global data. Monday, global data. Sunday night, Monday morning, usually global data sets the tone for the rest of the week. Then I want to go through the calendar, and then I want to go through the indexes, and then I want to go into the bullish versus the bearish sentiment. So today we're going to give you a good little overview of what to expect for the week ahead. Now, global stock markets rose Monday after President Trump avoided reigniting a trade war. A trade war with China. Although U.S. indexes appear to be set open a little bit weaker. Hong Kong stock market surged 3% and European shares were higher. Investors appear to be relieved that Trump avoided pulling out of the truce in a trade war. I do have to say right now, and I've said it before and I'll say it again, I'm not just reading this, I'm kind of going over this as I'm going down. Do you guys think this is a great time to start the trade war or continue the trade war where we still don't know where we're going to be with this COVID-19? I think it would have been a little smarter and prudent to push things back a few months, but what do I know? U.S. seemed overshadowed by civil unrest where protests against police brutality and racism have become violent in multiple cases. The protests come at a time of surging unemployment and just as the country was looking to ease its lockdown measures. Not good. Timing, you know what they say, when it rains, it pours. A monthly gauge of Chinese manufacturing issued by Business Magazine, Caixin edged up to a 4-month high, but new export orders fell from an already low level in sign of weak global economy. Things are not going to pick up for several quarters, probably 2 or 3 quarters, till we figure out how bad this first quarter was. U.S.-China tension has weighed on investor optimism about the global economy's recovery from its deepest slump since the 1930s. And that's why I say, is this a really appropriate time to be talking about trade tensions? I mean, look, the truth is, the Chinese have been hosing us for years with the trade, with the tariffs. They've been hosing us for years. And yes, it's definitely time to do something about it. But maybe it's best to wait a few months, just, till things cool off with this COVID-19. I'm not an economist, what do I know? But that's my opinion. The world's 2 biggest traders has raised tariffs on billions of dollars on each other's goods. They signed a truce in January. Oh, I remember that. But Trump added to market jitters by threatening to pull out if China doesn't buy more American goods. And I don't think that's really going to happen. It's just posturing, which Trump is really good at. On Friday, Trump said Washington could begin eliminating agreements that gave Hong Kong privileges that China lacked, including exemption from some import controls. This thing is getting hairier and hairier, and based on what I'm seeing, we're not going to see any signs of things getting better for the foreseeable future. And that means the markets are going to be volatile, increased tension, increased volatility, because we don't have a level of foreseeability right now. We don't have a denominator for the COVID-19. We don't have a vaccine. This trade war has no sight of ending. We've barely edged out a tentative, temporarily wishy-washy, very vague phase 1 agreement and kind of left it at that. And then we had the COVID-19. So things are kind of, in my opinion, and I think this is going to turn out, I think this trade war is going to be pushed back, especially if U.S. feels more vulnerability over the next few quarters. Because let's be honest, the U.S. is not in a position to bark at anybody right now. We're not doing so well either, okay? I mean, we've got the worst economic data since the World War II. So, in my opinion, right now is probably the best time for both sides to kind of cool off and keep things civil for the foreseeable future. So let's talk about the week ahead. Expect sideways trading action, more volatility, some congestion, and for the S&P 500 and the NASDAQ to possibly test the 200-day moving average once again. Because I don't think the worst is behind us, and I think the second shoe hasn't dropped yet. Let's talk about what we can expect this week from Wall Street. We've got We've got PMI manufacturing, ISM manufacturing, but the big reports are going to come Thursday. We got international trade, jobless claim, and Friday, the employment situations. The employment situation has been really, really odd, and so has jobless claims. Things are just all over the place. The consensus this week is 1,700,090 unemployment. Don't think that's going to happen. The 4-week moving average is at 2.6 million. Last week we had 2.1 million. As long as the numbers keep getting smaller and smaller, as long as we get the trend is going down and not up, that's positive. So anything below 2 million will be positive. 1.8, 1.5, that's okay. Anything, as long as the moving average is moving down. But the consensus is 1.79 million. So keep your eye on that number. That's a very, very important number. We also have unemployment data coming out on Friday. And again, the numbers are all over the place. The key here is the unemployment rate. And prior was 14.7%. Consensus is 19.8%. And look at the consensus, all the way from 17.5% all the way to 20%. Can you imagine 20 million contraction and another 7 million expected? We're talking about a massive, massive, massive unemployment spurt or spike. Either way, this is not a time for the Fed or the president to become really authoritative with China because, I mean, look at these numbers. We're not doing really well either. 20 million, over 20 million unemployment, another 7 million. Consensus from 11 million to 3.5 million. I mean, just things are tough all over. All right, now, that's the employment. That's what the market's going to be anticipating as we go into Thursday and Friday. Expect a little more volatility Monday and Tuesday, and then a little weaker volatility, and then a pickup again in anticipation of the employment data on Friday. In terms of sectors, I told you last week something big is happening. Technology and consumer discretionary are not next to each other. Now healthcare is in second place. And if things go the way I'm anticipating they will, I think technology and consumer discretionary are going to be cooling off over the next few weeks and taking a backseat to healthcare, which means healthcare will become number one and technology and consumer discretionary will become second and third place. Always note this. If technology and consumer discretionary are not next to each other, that means the market is becoming either overbought or oversold. One way or the other, the market is becoming fragmented. And when the market is fragmented, that means usually 80% of the time, the market needs to correct a little bit. Because without a correction, it's going to stay fragmented. And when the market is fragmented, it's not going to find directional bias. Now, speaking of directional bias, we now have that. We actually touched the moving average again, so we don't have full 2 days clearance. And this is what I was talking about. This is why I say, if you want to know if the S&P is bullish, always check for 2 days of clearance. So we had no days of clearance. We touched the moving average here. Then we had 1 day of clearance. Then we touched the moving average over here. And now before the open, we have another clearance. Again, I believe the S&P 500 is going to tread around the S&P around the 200-day moving average for the foreseeable future, and we're going to hang out this territory here. Now, it doesn't mean we're not going to move above the 200-day moving average. I keep saying 50-day moving average. It's the 200-day moving average, but we're not there yet. And again, just Thursday we touched the 50-day line. The 200-day line, I keep saying it again. And as long as we keep touching it, we don't have clearance. I want to see 2 days like this, 2 days like this. Anytime we touch 200-day line, no soup, the market is fragmented. Looking at the NASDAQ 100, and this is the sector that I believe is going to cool off. I think we're a little overbought. I think we're going to become choppy, and we're seeing divergence between price action and the RSI oscillator. And that's exactly what happened before the big sell-off right here. Price was going higher and oscillator was going weaker. Weakness here, lower highs, higher highs. Price has higher highs, indicator has lower highs. Look at this, higher highs, lower highs. Odds are we're going to cool off and hit the 50 and the 200-day moving average, which is covered by this green line right here. So again, I'm expecting the S&P to start heating up a little bit. I'm expecting the Nasdaq to cool off a little bit. More choppiness, sideways trading, with the expectation of waiting for the news this week, Friday and Thursday, which is not expected to be really rosy and peachy. And with the sectors being out of whack, with the technology and consumer discretionary being away from each other, being spread apart, with the healthcare being in between, it's telling me that the market is due for a little pullback, that there's a fragmentation in the market, which means we can expect sideways trading action or possibly some downside for the immediate future. So don't get too bullish right now, and be extremely selective. You've got to know what sector to be in and what stock to be in. This is not a time to think ahead. This is time to trade based on what's happening right now. And speaking of right now, this stimulus bill is creating clear profit signals for traders every day. And with very little effort, in just a few minutes each morning, you can earn, get this, 1,139.67% return with one of my favorite trading strategies. You see, a lot of huge traders are being placed before the market opens. Notice I do all of my analysis for what the market is going to do. I do it before the opening bell, because you see, European markets, Asian markets, they're telling us what the US market is going to do that day ahead of time. So if you know what to look for, you can make out like a bandit. So if you can spot these before the bell sounds, you can piggyback off these huge money moves, make big gains with safe blue chip stocks. I'm not kidding. Look at this. I did a full, complete analysis before the market opened based on what I'm seeing on overnight session. And this means you can earn thousands every single day. Get a clear, unfair advantage, and you don't have to sit there like this looking at the market all day with your computer. Forget about that. You can enjoy your cup of coffee in the morning, and you don't have to sit there all day in front of a computer. Click the button below or the link at the end of this video. Get in on this now. Safe blue chip stocks, earn 1,139.67% with your favorite strategy, while all the traders are just getting ready for the day. You analyze the market before the open, you place a trade at the open, and you cash out just a day or two later. Don't have to sit in front of your computer. Enjoy your coffee. While you're getting your coffee and finishing up your day, everyone is just getting started. I love that. Don't miss out. I'll talk to you guys soon. Check it out right now. Bye.